Strategic property investors plan for the long term, and theoretically, therefore, they should be immune to the ups and downs of the property market and our economy. However, the grinding reminders of the economic challenges that we're facing, well, they can be a harsh test for the character of even the most experienced investors. There's the continual news about rising inflation, higher interest rates, of course, how this could lead to a significant downturn in our property markets if you listen to the wrong people. So how can a property investor prepare for the possible turbulent times ahead? That's what I'm going to ask leading financial advisor Stuart Weymss in today's show. So welcome to this episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
I recently read an interesting quote from Morgan Housel, one of my favourite finance commentators. He said, "Your lifetime results as an investor will be mostly determined by what you do during wild times." He went on to say, building wealth doesn't require a lifetime of superior skill. It requires pretty mediocre skills, basic arithmetic and a grasp of investing fundamentals, but practiced consistently throughout your entire lifetime, especially during times of mania and panic. Now, of course, that's easier said than done, but then again, so is everything in investing. Now, recently, leading independent financial advisor Stuart Weymss, founder of Pro Solution Private Clients, wrote a great blog about preparing for a bumpy ride ahead. And that's what I'd like to discuss with Stuart in my monthly chat with him. Hi, Stuart.
Hey, Michael. Thanks for having me back again.
Now, it seems that you believe we need to be prepared for the possibility of the next couple of years being a bit more of a bumpy ride.
Yeah, I think so. You know, we've got to distinguish between the facts and what the media are telling us because, even just with the recent interest rate increases, you know, they're interviewing Joe Public on the TV and they're talking about it like interest rates are 10%, you know, which is kind of funny when interest rates really historically are still ridiculously low. And if I had told you 5 years ago that unemployment would be this low and interest rates would be this low, okay, sure, inflation's a lot higher, you would go, well, that's a pretty good outcome. You know, my mortgage is pretty cheap at those interest rates. So
sure, they were at wartime rates. There was zero, basically. Money was so cheap. But now, even when they will keep going up, they're still currently well below where they were when we started the pandemic a couple of years ago, Stuart.
Yeah, so I think there's some things that will play out over the next 12 or 18 months that are negative. The reason I really wrote the blog was to kind of prepare people for a lot more negative news, not only from commentators, economists, general media, and even dinner party conversation. But really, if we look under the hood of all those conversations, it isn't all bad news, and we've got to put it all in perspective. But the problem is a lot of investors are influenced by sentiment. And the quote by Morgan that you just shared, I like a lot of his stuff that he writes. It's so simple, but so succinct and so perfect. And he's spot on. You know, investing is simple, I think, but it's not easy, you know, and that's the problem. And it becomes less easy or harder during times of uncertainty because you are getting battered around with a whole lot of hysteria, ridiculous predictions. And the best way to get media, Michael, as you would know, is to come out with a stupid prediction, you know, and as long as you've got some, even just a tiny pinch of credibility, you know, you'll get it, the papers will pick it up.
Sure. Oh, it's much easier to get a headline if you've got a negative idea rather than if you're going to say something positive. But I think we've got to put this into perspective. Yes, there are issues going on, but Australia's economy is still the envy of most of the world. Our economic growth is around 3.3%. And it's going to be a little bit higher this year, then a bit lower next year over the year. Unemployment's still at historic lows and there's more jobs advertised than ever. interest rates, as we said, they're at historic lows, and they're going to go up a bit, but they're still going to be lower than most historically they've been for a long time. The problem is, of course, a lot of people have never experienced a rising interest rate. It hasn't happened for 11 years, so most investors aren't familiar with that. Our stock market, it's down, but nothing like the US stock market. Retail trades up, planned business investment is there, skilled vacancies at record highs. The simple fact is we're in the box seat to still take advantage of the economic growth that's going to happen over the next year or two, Stuart.
Yeah, and I mean, we'll talk about some of the headwinds that might be coming our way, but the other thing we've got to keep in mind is that in times of high uncertainty, sometimes it's the best opportunities. With Buffett's old adism, be greedy when people are fearful and be fearful when people are greedy. It's true because, if you can kind of buck the trend a little bit, if everyone thinks investing in property is crazy, then often that is really the best time to invest in property because firstly, you're not going to have to overpay to get a good quality asset. And there's, I think to buy under fair market value requires a lot of luck being in the right place at the right time, but that's more likely to happen in a fearful market than a buoyant one. Michael, I was reading a blog yesterday, and there's the author of the blog was saying that the Chinese symbol for crisis is two sort of letters or however symbols, I think is what they might call it, and the two symbols, one stands for danger and one stands for opportunity. The two together means crisis. So it's kind of, I read that and I thought, well, it is kind of true. It's kind of what we're saying is in a crisis, there's certainly danger, but in a crisis, there's opportunity too. And if you're an investor and you're looking for the opportunity, you'll see it. But if all you see is a lot of negativity, bad news and things to worry about, then you'll never see the opportunities that the market might present.
Optimists have always done better in the long term, but I think the message you gave a moment ago, I don't want it to be lost. I think it was really important. There is going to be a lot of negative news, so be prepared for it. I think the other way you can be prepared for it is by having a plan. And I know that's what your team at Pro Solution Private Clients do and we at Metropole do. By giving our clients a plan and a holistic plan, then you default back to that. Otherwise, you end up going with what the media is saying or what somebody's told you at the barbecue, and you get pulled away from where you should be heading.
Investing requires a lot of discipline and a lot of faith in that you're taking the right approach. So, there's discipline comes in sort of two ways. Discipline sometimes to do nothing, and discipline to execute on the plan, which means to do something in times of uncertainty as well. And you've got to know when to do nothing and when to do something, of course. But quite often, that's why investing is simple but not easy, because it does require that discipline. And unfortunately, a lot of us make emotional decisions. In fact, a lot of decisions we make in life are based on emotion, and we justify them with logic after we've made the decision. But particularly with finances, particularly if you're thinking about your own money, that you've got a lot of invested emotion there, and it really can cloud your judgment, and it's really unhelpful.
Yeah, but we're human, aren't we? Now, let's talk a bit about inflation, because that's getting a lot of publicity and people are worried about it and scared about it. Now, we know that the Reserve Bank's inflation target is to get consumer inflation in the 2 to 3% band on average over a period of time. And we know for the last 10 years or so, that target's been missed on the downside. And now the Reserve Bank's trying to bring it down from 5%, and there's suggestions it may even go up to 8%, to that band of 2 to 3% again. I'm not even sure if that's relevant today. I read that that was something Bernie Fraser came up with in the 90s when he brought it back from 5% back then. Maybe it's not relevant anymore. But in my mind, recent inflation, I guess it's in some ways a sign of the success we're having. While too much inflation is a problem, it's important to remember that the jump we've had of inflation now is partly unintended consequences. We've actually had a lot of money. COVID has meant that we couldn't spend on certain things, and so Australia has got a bit of spare capacity to buy things. But in general, that's not what's driving it, is it, Stuart? It's really not demand-driven. It's more restriction of supply because of what's happened in Ukraine, because of the lockdowns in China. And I'm not sure that rising interest rates is going to stop that because it's not actually too much demand.
Yeah, my feeling is that rising interest rates won't have any impact, any measurable impact on inflation, because it's supply side driven. It's not like we're all going out and, buying a whole bunch of fruit and vegetable at Coles, and therefore Coles have to put the prices up because, demand is exceeding supply. It's merely a case of actually just buying some fruit and vegetables. And sometimes there's none on the shelves, and so supply is below demand. The really unfortunate situation is that supply side inflation is going to be painful because, and particularly for lower income earners, because it means that demand has to reduce below normal levels, which is going to require people to make decisions that they otherwise wouldn't otherwise want to make. Like, do I turn the heating on tonight? Do I buy fresh fruit and vegetables anymore, or do I go for a cheaper alternative? Those sorts of decisions. Again, higher income earners are probably insulated a lot from those outcomes, but certainly lower income earners are going to be hurt by that. And unfortunately, they're the ones that wore a lot of the pain during the lockdowns as well. So it's almost a bit of a double whammy. But until those supply chains rectify themselves, and obviously, we've got China's response to COVID, we've got the general sort of hangover from lockdowns and overseas migration and workforce and those sorts of things. And then I guess the big unknown is the Ukraine crisis, because those other factors probably in the next 2 years will resolve themselves. Ukraine could go on for years, of course, and wars just last years, unfortunately. So, but I think if we at least get over the lockdown issues and the bottlenecks, and China opens up, I think that'll go a very long way to dealing with a lot of the inflationary impacts. Having said that, Michael, interest rates should rise, but for different reasons.
And why do you think interest rates should go up?
Well, because interest rates were at emergency settings because we were locking people down, and through no fault of their own, they couldn't conduct their normal economic activities. And so the government had to do something to compensate, or at least, help them through that period. So that made sense. But having interest rates low for any longer than absolutely necessary can have, really negative, long-lasting impacts. And, people just don't start making good quality decisions when money is free. And, that can have wide-reaching impacts. So interest rates should definitely return to normalized levels as soon as the economy can afford it.
Well, the question, of course, is what is normal? So let's make it clear. Interest rates are currently stimulatory. In other words, they're making money cheap so people can go out and spend, so businesses can invest. And as you said, that was necessary to get us across that bridge that poor old Scott Morrison told us about. And he did get us across the bridge, and we're now on the other side. So the big question I know a lot of economists are currently wrestling with is, well, what's normal? At what level should interest rates be that they're neutral, they're not stimulating the economy, but they're not holding us back? That's not as easy to come up with, is it?
No, and the RBA's had a go at sort of forecasting it. Maybe it's 3.5% in terms of cash rate. I think they came up with. Most economists think it's probably lower than that. I sort of think it's probably lower than that as well. And the main reason is just higher indebtedness. People always recant, I remember when interest rates were, in double digits in the early 90s. Yes, but, there was a completely different environment, both from a banking perspective, a competition perspective, an interest rate management perspective, but most importantly, an indebtedness perspective, not only from households, but, we can't forget that the government's got $1 trillion worth of debt as well. So, that's going to have a big impact on government deficits as well.
So it's not an exact rate that's neutral. It's the effect that interest rate has got of slowing down the economy so it's not booming, but still growing and not being too stimulatory. So the suggestion could be interest rates will go up to maybe a total of 2% from where they were, or maybe a little bit more. That's the cash rate. We all know already that variable interest rates are creeping up, but fixed rates started to go up starting at the end of last year and very much throughout this year already.
Yeah, that's right. And I think while inflation is high, the inflation measure of 5.1%, which is the most recent reading from the ABS, I mean, I think it's ridiculous, right? You just walk through the supermarket or go to the petrol station and inflation, real inflation on our household budgets is much higher than 5.1%. So with a backdrop of high inflation, I don't think interest rates really need to rise that much for it to potentially send the economy into, a contraction. What might be normal interest rates is a good discussion, but neutral interest rate is a good discussion, but what's a neutral interest rate while we've got such high inflation? Well, I don't think it's much past 1%, I wouldn't have thought. Now, the problem will be, and I think it's entirely possible that Australia could slip into recession, but I would call it a technical recession because I think GDP growth will probably slow because consumer demand falls because house prices have stalled and all the negativity, etc. And you can certainly see, just walking around the city, retail's pretty quiet at the moment as well. So I think GDP growth will slow. Maybe it will turn negative. And if it turns negative for 2 consecutive quarters, that's what we call a recession. I think it will be a very shallow recession if it occurs. So nothing to really get too excited about, because I think at the same time, those supply chain issues will start to resolve themselves. So that's why I wrote the blog and say, well, be prepared for a lot of negativity because, that could be a real outcome. Now, it is a bit of a stumbling block, but for most investors and the people that are listening to this podcast, it's unlikely they're going to be impacted to a big extent. It's really those lower income earners that are kind of living from week to week. Unfortunately, it just makes wealth inequality even worse. Unfortunately, they're the ones that are probably going to really suffer.
Well, the real problem is if you've got high inflation, high interest rates, and unemployment, and even during a recession, if you've got your job, if you've got steady employment, and there's unlikely that that's going to be a big change because, as you said, it's not a depression, it's not the typical recession, it's just a slowing of economic growth, then it's the sort of thing that Australia should be able to ride through, just like the tiny technical recession we had during COVID.
Oh, we'll ride through it 100%. The underlying economy is very healthy. It really is this supply chain issue that needs to move through. And the fact that the RBA is increasing interest rates, which, as I said, for the reasons that I said they should, but it's just unfortunate timing that it needs to happen at the same time that we're dealing with higher cost of living. And so that's just unfortunate. But really, what could the RBA do? They could not raise rates. Well, that could be one option available to them. But I think the longer term consequences of them not doing that would be more costly.
A little bit of inflation is good for the economy, but too much means that really your dollar value, what you can spend with your money, especially if wages aren't going up, just goes down too much too quickly. And that's not a good end result, is it?
No, and you look at the factors that are driving inflation, oil prices, energy costs, commodities, these sorts of things. And you've had the floods in Australia that's had an impact on, fresh fruit and vegetables. Again, it's like a perfect storm, if you like. So inflation really isn't demand-driven. Demand-driven inflation, when inflation gets too high, that's a problem, right? You need to quell that. You need to quell spending, etc. But overspending, too much demand from consumers is not really our problem. We've got a sufficient demand from consumers. It's fine, but it's not really what's driving inflation. So I think it's very temporary. And when I say temporary, look, it could take up to 2 years to get through it, and it will be painful for some, and there will be a lot of negative noise. But I think if we look through it as investors and take that long-term view, equally there, from an investment perspective, it's an exciting little period ahead of us that could create lots of opportunities.
Sure, when things slow down, there's going to be opportunities for those who take a long-term perspective, and inflation is good for those people who own assets. But having said that, the biggest asset most people own is their home, and then 2 million Australians own investment properties. But property market sentiment, boy, has that changed over the year. We had the once-in-a-generation boom, a boom where last year property values around Australia increased by $2 trillion just in the 1 year alone. And now Melbourne and Sydney, they've been stagnant for most of the year. Prices have dropped a little bit, especially at the top end. But there's so many predictions out there of 10, 15, now even 20% fall in property values. In my mind, that's absurd. That's ridiculous. There's no reason why that should occur.
I might bore a lot of people for the next couple of minutes, but let's talk about statistics, Michael. So if you take Melbourne, the Melbourne property market, for example, the long-term return over the last 40 years from a median house price perspective, so I'm talking about average capital growth over the last 40 years, is 9%. If you look at the volatility rate, which is really how much prices change from year to year or month to month and so forth, it's about 8%. If you look at volatility in the share market, it tends to be around 18 to 20%. So it makes sense, right? So the property market's half as volatile as the share market. Most people think, that the term safe as houses, sort of reflects that. So we all get that property is less volatile. Now, from a statistical perspective, if you add and subtract the volatility rate from the average rate of return, then 2/3 of the time your return will be between that range. So if we say 9% less 8%, that gives us 1%. So that's our low end. And 9% plus 8% is 17%. That's our top end. So 2/3 of the time, our return from property will be between 1 and 17%, which again makes sense because property markets tend to either go through a growth cycle or they go through a flat cycle. They're not like share markets where they drop 30% and then recover, etc. So if you plus and minus 2 standard deviations, so 2 times the volatility rate, that'll give you your range where what your returns will be 95% of the time, right? So that's going to be something like -7 to +25 or something like that. Again, it's a very wide range, but it's encompassing 95% of potential outcomes. So for someone to suggest that the market's going to fall 20%, what they're saying is that there's statistically maybe a less than 2% probability. That's just based on actual data. And I like to make evidence-based decisions, Michael, because we can all get caught up in the hysteria, or we could get influenced by someone that's just trying to grab some media attention, or someone that truly believes that, there's some negative outcomes here. But if we really if we're going to be influenced by these things, what they're saying is, what they're predicting is really a less than maybe 2 or 3% probability based on 40 years of data. So if we're going to believe that, we've then got to understand why is this time so much different to the last 40 years? And that's what I really struggle with.
Well, for property values to drop 10%, 15%, 20% overall, we're talking about individual, like the top end of the market led the property boom this time and generally leads it and has now led the downturn a bit because that's not as deep a market. And at the lower end of the market, yes, some first home buyers have overcommitted, some investors have overcommitted a little bit. But in the middle of the market where a lot of people have no mortgage at all, a lot of others have got huge equity in their home, there's no reason for property values to fall. If people don't have to sell, they don't have to desperately sell because they've got jobs, they've got income. So it's only if they've got to sell and there's nobody there. But similarly to your research department, we've gone back 42 years. I think it's the same data we're using, the ABS data, which has shown that overall property values in Australia have gone up 540%. And that's the figure to think about, that's the interesting one over the last 42 years, not the occasional drops, because there will be drops and they're temporary, but it's the long-term trend that's up. And Melbourne, you correctly say, actually had the best long-term results, but there isn't one Melbourne market or one Sydney market or Brisbane market. So I guess the way I'm preparing myself moving forward is, and I know you are and you're advising your clients also, is to own the right assets, the ones where there's strong market depth in areas where there's not going to suddenly be a significant fall in values.
No, and if you think about the areas, those good quality blue chip areas, there tend to be, the people that own properties in those areas where they're own occupiers or investors tend to be, higher than average income earners. And we know that that cohort, which you correctly said, Michael, drove the boom through 20 and 21. We know that cohort have retained their income through COVID. have increased their savings in offset accounts by a ridiculous amount. I can't remember, $200 billion or something like that. You might know the figure, Michael, but the point is that they can stomach higher interest rates. That's not going to worry them. They can stomach higher prices at the supermarket. That they won't enjoy it, but it's not going to upset them. Certainly, there's going to be some motivated vendors out there that might have got themselves into trouble, but they are the absolute minority, particularly in those blue chip locations. So, when you ask what's going to drive a 20% reduction in property prices, I struggle to think of a thing that's going to do that.
Look, even during the pandemic, when people weren't renting in the CBD, when tourists weren't there, when Airbnb disappeared, when there was huge vacancies in the apartment market in the CBD, property values didn't drop that much during the worst of times. And now the opposite's happening. Tourists are back, Airbnb's back, international students are back. So even the more complicated, difficult segments of the market shouldn't have significant falls.
No, people are reluctant to sell property because it's such a lumpy asset and the entry and exit costs are so high. So they typically persist with it for maybe even longer than they should, but they do. Whereas shares, you can click of a button, they're gone. It'll cost you $10 to sell it, and you're out. You can have a knee-jerk reaction. You can't have a knee-jerk reaction to property, and even if you do, by the time you interview some agents, get the property ready for sale, et cetera, by the time you've gone through all that, your fear is probably subsided, and you've worked out that it's not the right thing to do. So. I think it's, and then the other thing, if we're going to take an evidence-based approach, properties never drop 20% ever. So again, is this time so extraordinary that that it's going to happen?
The overall property markets of Melbourne, Sydney or Brisbane, mining towns did, certain segments did. Sydney and Melbourne dropped a bit for a really short time when there was the credit squeeze, the credit crunch in the 70s, 2017, 18. But overall, and that's what people are talking about, the overall market dropping, that's never happened.
No, it's never happened. And really, when I talk about property, I'm thinking investment grade assets rather than mining towns and so forth. And look, I think, my sort of personal opinion on regional and beachside locations, I wouldn't be surprised if they experience a price correction because the growth in those markets have been extraordinary. So there could be segments of the market where we see price falls, but if we're talking about blue chip locations, I just want to say it's not going to happen.
Now, people have been asking me, and I bet your clients are asking you, what's ahead? What's your forecast? How high are property values going to go? How low are they going to fall? How high are interest rates going to go? And I was only actually yesterday asked that by somebody in the media, and I think I disappointed him because I actually said I don't make forecasts. And he didn't like it because that's what they want. And if people go ahead and give them a forecast, that grabs the headlines. But what I said was I have expectations. And I explained there's a big difference between forecast and expectations, Stuart. I expect that interest rates are going to keep going up, but I actually don't know for how long and how high they're going to go. I expect property values in some locations are going to drop, but I really don't know how much and when they're going to start picking up again. I expect there's going to be another recession. It could well happen if interest rates go up, but I'm not even sure. And I expect that our economy is going to pick up again, but who knows by how much. I even expect there's probably going to be another world financial crisis, but I got no idea when that'll come. And then I explained to him, that's not a contradiction. It's not a form of cop-out. There's a big difference between expectations and a forecast. I anticipate how things are going to play out based on my experience, the perspective I've had investing over 5 decades. The difference is a forecast putting a time frame to those expectations. Of course, in an ideal world, we'd like to know. We'd like to have a forecast. We'd like to know what's ahead with a better level of accuracy. But we can't. There's just too many moving parts. There's all those different millions of strangers in Australia, each responding to the prevailing economy, to the political environment, to consumer confidence. There'll always be an X factor. But by planning for the worst, but expecting the best, I'm going to get through this. Just like I've planned by having buffers, I've planned by having insurances, I've planned by owning the right sort of properties. And I knew there was going to be a downturn. I didn't expect a pandemic. I didn't know it was going to come. And when it came, I was ready and prepared for it. And I had the buffers. I didn't need them. My properties did better than I expected. My business did really well as well. So I'm prepared again. And I'm going to get through this one as well, Stuart.
Yeah, so I mean, if you ask me from a personal perspective, what do I think is going to happen with property prices and interest rates and inflation and those sorts of things, as opposed to responding to those things as some sort of commentator or some sort of analysis. But my personal view is I don't really care. I hope my wife and I hope to buy a good quality investment property in Melbourne this year if the right opportunity arises. I realise that if I do that, and hold the property for 30 years, the interest rates are going to be different over that time. The governments will be different. The tax legislation might change. Inflation might change over those times, all those sorts of things. I realise that, for example, if property falls, 5% over the coming months and I go and buy something and that falls a further 7% after I buy, I realise that's a potential outcome, but I don't care. Because no one can really predict where the market's going to bottom out or if the market's going to bottom out. And in 30 years, it really won't matter at all. I mean, it's probably not going to matter in 3 years, let alone 30 years. So we don't really care about those factors. I just really think, is this a good property? Is it a fair price for that asset? And can I afford to hold that asset for long term? They're the three things that I'm only focused on. I don't really care what interest rates are going to do, and I would argue nor should anyone else, because it would just invite you to make a short-term decision, and short-term decisions from a financial perspective are almost never right.
Now, I want to finish this off with three things you're going to recommend our listeners to do. But before I do, I want to remind listeners that this came from a blog on Pro Solutions. And so therefore, if you want to find out more about what Stuart does for his clients and read his regular weekly blogs, I'm going to leave a link in the show notes. But Stuart, you also have a podcast which is becoming more and more popular, and it's often just a discussion of your weekly blog as well. So some people like listening, some people like reading. And so you've got lots of great information. I'll leave a link in the show notes. But before we get the three tips to finish off, what do you do for your clients at Pro Solutions? Give us a quick hint at how you can help people.
We try to inspire clients to adopt a holistic approach when making financial decisions, Michael. So, and the reason for that is that many financial decisions have many interrelated factors to take into account. So, for example, buying a property, I've got to think about tax, I've got to think about borrowing, I've got to think about cash flow, I've got to think about financial planning, I've got to think about how it fits into the overall long-term strategy. And so they're all interrelated. And so if we can take a holistic approach and have a team that are talking to each other and collaborating with each other, then no opportunities get missed and no risks get missed either. In the absence of that, it's up to the individual to spot all those opportunities and risks, and most investors don't necessarily have the skill and experience to do that. So that's what we do at our team: build those long-term relationships and help them.
So while you don't buy property or advise on property, you're an accountant, you're a financial planner, you've got accounting team as well, and mortgage broking. So you bring all those skills, but they are interrelated. The left hand should really know what the right hand's doing. And then we have some clients in common, and clients do things without Metropole as well. And that's fine. But that's why I love having a chat with you, and I like referring clients to you because of your holistic approach. So we'll leave a link in the show notes about Pro Solutions as well. But let's finish off with maybe rounding all this up with three bits of advice that will help our listeners over the next year or two.
Yeah, sure. So the first one, I mean, it's about having patience and discipline to act when you need to, and patience to not act when you don't. And so the three things that I'd like to leave people with is that the first one is that realize that all markets move in cycles. Everything kind of moves in cycles. Now, the cycles in property market tend to be different to the share market, for example. The share market will go through a bust and then a boom, recovery, all those sorts of more significant phases. I find property markets tend to go through, either a cycle of growth or a very flat flat cycle, but realize that things move in cycles, which means that if you own an asset and you bought at the end of a growth cycle and the time you've owned it is through a flat cycle, but the asset is otherwise fundamentally sound, you need to have the patience and discipline to sit with that asset and realize at the end of the day it's going to deliver those returns. But also, and particularly if we go through, a period of a lot of negativity, it could create a different cycle and an opportunity as an investor as well. And that too requires discipline in terms of executing. So if we see, for example, if the share market dropped 30% tomorrow, I'm probably going to go and buy some shares. Well, I'm almost certainly going to go buy some shares because they're cheap relative to where they were. So again, markets move in cycles. Sometimes those cycles can be driven by, the narrative of the day. Sometimes not, and it's just something to keep in mind.
So the first lesson is the market moves in cycles. I guess the next one is expect more bad news. We started right off with that.
Yes. The next one is, returns compound. So realize that, chopping and changing, particularly during a time of high uncertainty, destroys wealth. What you really want to do is if the asset was fundamentally sound, then regardless of what happens over the next 2 or 3 years, the asset will work. Don't make any changes. Don't read into or fall victim to all these silly predictions of property prices crashes or major recessions or all these sorts of things. These things might happen, but we're long-term investors. So let the returns compound and don't get involved with it. And lastly, the third one is that to try and minimize transactional costs. So again, it's kind of interrelated to the second point, but really chopping and changing your strategy, selling the shares, selling the property, doing all those sorts of things. Ultimately, they destroy wealth. Again, if your assets are poor, okay, you've got to fix it. But if your assets are fundamentally sound, sit with them.
Right. So thank you. I think having the perspective that you've had investing for so long, helping so many clients, and I've had, gives us a different view. That's the benefit of perspective of having invested for decades compared to some beginners who are going to be spooked by this. So don't get spooked by the volatility. Don't get spooked by the negative sentiment, and don't make big changes based on the last 20 minutes or 30 minutes of news. Don't make 30-year investment decisions based on what's just happening. By the way, Stuart, interestingly, we've said the same over the years. Nothing's changed. We gave that advice during COVID. We gave that advice before COVID. The message, the underlying fundamentals don't change.
My wife reads my blogs every week as proofreading, make sure that they're understandable and so forth. And she turned to me last week, I think it was, and said, "Oh my God, Stuart, they're all sounding the same." And I feel sorry for her because she's got to read them. But I mean, it's true that the themes really, there might be a different point I'm trying to get or principle I'm trying to get across, but the underlying themes are the same. They've been the same for decades and they will be the same for decades.
Okay, so we're going to have to find something new to talk about when we catch up next month. I look forward to catching up with you in a month's time, Stuart.
Thanks, Michael. Cheers.
In a moment, I'm going to share my mindset message with you, but I hope my chat with Stuart has given you some comfort that things aren't as bad as some of the property pessimists are making out. But if you're wondering how should you invest in this interesting phase of the property cycle, or even if you should invest in the property cycle, if it's this stage, if it's right for you, should you buy, should you sell, should you just wait? You can trust the team at Metropole to provide you with direction, with guidance and results. So whether you're a beginning or an experienced investor, at times like we're currently experiencing, you need an advisor who takes a holistic approach to wealth creation. And Stuart and I both discussed that just a moment ago. And that's exactly what you're going to get from the multi-award winning team at Metropole. Remember, they're going to help you with the frameworks I've built over 5 decades, and we've been helping clients with for well over 2 decades. I've lived through times like this before, so we help our clients grow, protect and pass on their wealth through a range of services. So go to metropole.com.au and you'll find out what we do. And what we don't do is sell property, so therefore we can give you independent advice. And it all starts with strategic property advice. Why not allow us to build a strategic plan for you, for your family? because planning is bringing your future into the present so you can do something about it. And then you may want to use our buyers HSE wealth advisory, property management, renovations, development, even business advisory services. Financial planning, we've got a range of ways we can help you, but I don't even know what you need. So why not go to metropole.com.au, find out a bit about what we do, and I look forward to being part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
Today, I'm going to share a bit of a heavier mindset session with you. But pay attention. I hope you'll get some benefit from it. And I'm calling it 3 reasons why you are not your thoughts. Let's go through it. Number 1, the concept I'd like to get across is that your mind's not a camera, it's a projector. Now, what do I mean by that? Look in the mirror. What do you see? You should see your face. But how would you describe it to somebody? Perhaps the person in the mirror is a young person filled with energy, yet also wise with age. The way we see and describe anything is different for every person. We all have our unique experiences and our past conditioning. We're bringing along all that baggage with us. As Michael Neal writes in his book, The Space Within, we live in a world of thought, but we think we live in the world of external experience. The mind's not a camera, it's a projector, he says. We can't tell the difference between an imagined experience in here in your mind and what's really going on out there in the outside world. And that confusion creates a lot of confusion. You see the world as you are, not as it is. And that's part of the reason I spend time discussing these mindset messages with you, so that we get a realistic understanding of what's going on in your head, because the outside world won't change until your inside world does. You've heard me say it before. It's in my Rich Habits, Poor Habits book, and in the podcasts I do. We're all walking around with one foot on an accelerator and one on the brake. We've got empowering beliefs and we've got disempowering beliefs. So we're not really seeing the world as the world is, but we're seeing it as we are due to all our preconditioning, the beliefs, the good and the bad that we carry with us. So understanding what's right and what's wrong is ultimately a matter of perception. So how do you envisage the outside world? How do you assess what's going on there? And as I started to say, it's because of the reticular activating system, the conditioning that you've got that filters things. So we see the world as we are, not as it really is. So I guess step 1, I'm trying to mention about the 3 reasons that you're not your thoughts, and that you've got to change your thoughts so that we can actually move forward, is that your mind's a projector. It's not a camera. Of course, perception is reality. So if you imagine something to be as it is, then that's your reality. Okay. The second concept I'd like to get across today is that you're constantly going through a system upgrade. If I asked you who you are, you'd likely to start with what you do for a living, or recite a list of your past achievements, or where you've been, or what your values are. But who is the person behind those beliefs, behind those thoughts, behind those ideas? Who are you now, right now, in this moment? It's important to ask this, because where you want to be, where you want to take your profession, your business, your life, your investments, is going to require a different version of you to show up. Remember, your personal wealth will never outgrow your personal growth. So for you to get to the next level, you're going to have to grow to become a different person. Often you need to rip out all your old belief systems that worked, but it only got you to where you got to now, and you've got to build new ones that are relevant. Because if you don't like system upgrades, you're going to be like that BlackBerry, or remember that old phone that's faced extinction. Interestingly, that's why I have had a mentorship program for over 15 years to help people understand their internal wealth operating system, to upgrade their thermostat. And that's one of the extra things that we do at Wealth Retreat. One of the first things we actually do at Wealth Retreat, which is going to be held in November this year, we're going to actually work on people's empowering beliefs and limiting beliefs. So we've got to clear all out the limiting beliefs, instill a whole lot of new empowering beliefs, do a system upgrade on them, and then, and only then, are they going to be able to take advantage of all the information that we give them to help them. Okay, the third point I just want to get across, or the 3 points I want to get across to you today in this mindset session, is pain can feel crippling, or you can use it as a stimulus to growth. In their best-selling book, The Tools, the authors, who are also psychotherapists, said, your experience of pain changes relative to how you react to it. When you move towards it, pain shrinks. When you move away from it, pain grows. If you flee from it, pain pursues you like a monster in the dream. The more pain you can tolerate, the more you can learn. Now, the same sentence could be true if you replace the word pain with fear. Pain and fear will surprise you if you're open to possibilities without knowing how things will unfold. If things are tough right now for you, they won't last. If things are good, unfortunately, they won't stay good forever. The important thing to ask yourself is, what's the lesson in this? Because when you stop living in your thoughts, life becomes an experience. Thanks for spending the last half an hour or so with us, and I hope my chat with Stuart has helped you in these interesting times in our property cycle. By the way, there's lots of shows, almost 400 shows in our archives, where each one's an individual episode where you can get lots of information. So if you enjoyed today's show, just go back and listen to some of the other guests of the Michael Yardney podcast. In fact, I can see from the download statistics that lots of our new listeners and even established listeners are doing that. Now, again, if you did get some benefit, and you know somebody else who'd get some benefit, you'd be doing me a real favour if you told them about it. In fact, you'd be doing them a real favour. So you might me a favour. I want to make as many people as possible financially fluent. So please help me and help your friends as well. And I'm going to help you because I've got a gift for you. As somebody who listens to this podcast, go to podcastbonus.com.au and you can download a range of reports and ebooks. I'll be back again real soon, but you can catch me on social media in the meantime. Just look for Michael Yardney, or why not join our private Facebook group where every day I leave some information, some charts, some tips that I don't leave elsewhere. Go to Facebook and look for the Property Update private Facebook group. As I said, I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?